You check your bank account late at night, and you see a number sitting there. You think that number is your wealth. It's not. It's just cash sitting there, doing absolutely nothing at all, quietly losing value every single day to inflation, whether you notice it or not. Real wealth isn't a number in a checking account. Real wealth is ownership. And the fastest way regular people build ownership without needing millions of dollars is something most of us were never taught properly in school: the stock market. Most people think the stock market is a casino. Red and green numbers flashing, people yelling on TV, some guy on social media claiming he turned $500 into $50,000 overnight. That's not investing. That's gambling wearing a suit. Real investing is boring. Real investing is slow. And that's exactly why most people never do it right and quit before it ever pays off. Let's start with the basics. What actually is a stock? When you buy a share of a company, you are not just buying a piece of paper or a number on an app. You are buying a tiny sliver of ownership in a real physical business. If that company makes more money this year, the value of your slice goes up. If that company loses money, your slice loses value too. You're not betting on a ticker symbol. You're betting on a business, its employees, its products, and its future. So how does a company end up on the stock market in the first place? Every company starts private. A founder has an idea, a handful of employees, maybe a garage and a dream. To grow faster than their own savings allow, they need outside cash. So they sell pieces of the company to the public in something called an IPO, an initial public offering. From that day forward, anyone with a brokerage app can own a piece of that business, right alongside billionaires and pension funds. That's the entire point of the stock market. It connects people who have extra cash sitting idle with businesses that need cash to grow. Meet Chase. Chase is 26 years old. He saw a stock trending on social media last month, put his entire savings into it in one single afternoon, and now checks the price 40 times a day between meetings. Now meet Morgan. Same age, same starting salary, same city. Morgan puts a fixed amount into a diversified indexed fund every single month like clockwork and genuinely doesn't check the balance for weeks at a time. 10 years from now, one of them will likely be financially free. It will not be Chase. Here's the part that surprises most beginners. Stock prices don't move because of vibes or headlines alone. They move because of expectations. If a company's earnings beat what analysts predicted, the price can jump instantly. If a company misses expectations, even while still being profitable and growing, the price can crash the same day. The market isn't pricing today. The market is constantly pricing the future. You're not paying for what a company already is. You're paying for what millions of people collectively believe it will become. Now, buying one single company is risky, no matter how much research you do. What if that one company gets outcompeted or mismanaged or simply falls out of favor? This is exactly where indexes come in. An index, like the S&P 500, doesn't track one company. It tracks roughly the 500 biggest companies in America all bundled together. When people on the news say the market went up today, they usually mean the S&P 500 went up. Buying a single index fund means you don't have to guess which one company wins the next decade. You basically own a slice of the entire American economy in one purchase. This brings us to the single most important rule in all of finance: the risk-return trade-off. The higher the potential reward, the higher the potential loss sitting right next to it. There is no investment on earth that hands you huge returns with zero risk. If someone online promises you exactly that, that's not an investment opportunity. That's a scam wearing a nicer font than usual. Chase learns this the hard way more than once. Morgan never has to, because Morgan never believed the lie in the first place. Let's talk about how you actually buy a piece of a company, because this part confuses people more than it should. You don't walk into a building and buy a stock from a person behind a desk. You open a brokerage account, something you can do from your phone in about 10 minutes. And behind the scenes, that brokerage connects you to what's called an exchange, like the New York Stock Exchange or the NASDAQ. That's where buyers and sellers actually meet millions of times a second, matched up almost instantly by computers. When you tap buy, you're not buying from the company itself. You're buying from another investor somewhere in the world who decided to sell at that exact price. Now, markets move in two broad moods, and you'll hear these terms constantly.
A bull market is when prices are generally rising and confidence is high. Everyone feels like a genius. A bear market is when prices are generally falling, usually by 20% or more from a recent peak, and confidence disappears fast. Here's what almost nobody tells beginners day one. Bear markets are not the enemy of a long-term investor. They're actually the best buying opportunities of your entire investing life, because you're purchasing ownership in real businesses at a temporary discount. Chase sees a bear market and runs. Morgan sees a bear market and quietly keeps buying on schedule, same as always. There's also a stranger move called short selling, where investors actually bet on a stock going down instead of up, essentially borrowing shares, selling them, and hoping to buy them back cheaper later. It's an advanced high-risk strategy, and like a normal stock purchase where your maximum loss is what you put in, a short position can theoretically lose you far more than your original investment if the price keeps climbing. Not something a beginner needs to touch, but worth knowing it exists. And whenever you do sell an investment for a profit, the government wants its share too, through something called capital gains tax. Hold a stock for over a year before selling, you're typically taxed at a lower long-term rate. Sell within a year, it's usually taxed like regular income, at a much higher rate. This alone is another quiet reason patience gets rewarded and impatience gets punished, twice over. Smart investors protect themselves with something deceptively simple: diversification. Don't put all your eggs in one basket. Spread your money across different companies, different industries, sometimes different countries entirely. If one sector crashes, the rest of your portfolio can hold the line. This single habit is often the exact difference between someone who survives a market crash intact and someone who gets completely wiped out by one bad quarter. Stocks aren't the only piece of this puzzle, though. There are also bonds. When you buy a bond, you're not buying ownership at all. You're lending money, either to a company or directly to the government, and they pay you fixed interest in return for a set period of time. It's slower, it's less exciting, but it's far more predictable than owning stocks. Serious long-term investors rarely choose between stocks and bonds. They hold both at once, gradually shifting the mix towards bonds as they get older and want to protect what they've already built. Along the way, some companies also pay you just for holding your stock through something called a dividend. Think of it as a small regular payout, a thank you for being an owner, on top of whatever the stock price itself does. Not every company pays one. Younger, fast-growing companies usually reinvest everything back into growth instead. Older, more established companies often reward shareholders directly with cash instead. Then there's a much wilder corner of the market: derivatives, things like options and futures. These tools were originally invented to help farmers and manufacturers protect themselves against sudden price swings in raw materials. Today, for most everyday people, they've become something closer to a casino floor built directly on top of the stock market. Bets on top of bets. Extremely fast to multiply your money and just as fast to erase it entirely. This is not where a beginner should ever start. And then there's crypto, a decentralized system running on blockchain technology with no bank, no government, and no single CEO controlling it. To some people, it's the future of money itself. To others, it's a highly volatile experiment that behaves nothing like a stock and everything like pure speculation. Whatever side of that debate you land on, one thing stays true either way. It swings harder and faster than almost anything else in finance, and it demands respect, not hype. Here's the uncomfortable truth nobody tells beginners day one. The biggest threat to your portfolio was never really the market itself. It was you. When prices crash, fear convinces Chase to sell everything at the worst possible moment, locking in a real, permanent loss out of pure panic. When prices are soaring and everyone online is bragging, greed convinces him to jump into whatever's hyped, right before it inevitably crashes back down. Morgan does neither. Morgan built a simple plan in a calm, boring moment and simply refuses to make emotional decisions during a chaotic one. This is where compounding quietly changes absolutely everything given enough time. Morgan invests $300 every single month starting at age 25 without fail. Chase waits until he's 35 to even start, then throws in triple that amount every month to try and catch up. By the time they're both 60, Morgan will very likely end up with significantly more money, despite investing far less in total. Why does that happen? Time. Compounding needs time far more than it needs large amounts of money up front. The market ultimately doesn't reward the person who invests the most. It rewards the person who starts early and simply stays consistent year after year, market crash or not. One thing that makes all of this possible in the background is liquidity, basically how easily an asset can be bought or sold without wildly moving its price. Big, well-known companies trade so often that you can buy or sell instantly at a fair price. Smaller, less popular stocks can be much harder to exit quickly, which is exactly why beginners are usually better off starting with large, established companies or a broad index fund instead of chasing obscure names nobody's heard of.
One more habit separates the Morgans from the Chases: dollar cost averaging. Instead of trying to guess the perfect moment to buy, which almost nobody actually gets right consistently, you invest the same fixed amount on a fixed schedule, no matter what the market is doing. Some months you buy at a high price, some months you buy at a low price. Over years, it evens itself out, and it removes the single most damaging habit in investing, trying to time a market that nobody can reliably predict. So what did you actually learn in the last 15 minutes? A stock is real ownership, not a lottery ticket. A company goes public through an IPO, and from that point on, you're buying and selling with other investors, not with the company itself. Prices move on expectations about the future, not on feelings about today. Indexes let you own an entire economy instead of betting everything on one company. Bull markets reward confidence, bear markets reward patience, and the two always take turns eventually. Risk and reward are always connected at the hip. There is no such thing as a free lunch anywhere in finance. Bonds are the slow, steady counterweight sitting next to stocks. Dividends quietly pay you just for being patient. Derivatives and crypto are powerful tools that brutally punish impatience. Taxes quietly reward the investor who can wait a year over the one who can't. And your single biggest enemy in all of this was never the market itself. It was always your own emotions. Chase is still out there chasing the next hot tip, checking his phone 40 times a day. Morgan isn't rich yet either, but Morgan is already free because Morgan understood the one rule that actually matters more than any stock pick ever will. Time in the market always beats timing the market. If this finally made 15 minutes of finance make sense, hit like and subscribe because we're breaking down your money one video at a time.